I guess we're talking about startup venture funding. I'll say a little, even more briefly than planned, who I am. Johnny Kelly, I'm the founder and managing partner of J9 Partners here in Austin, Texas, which I founded about a year ago to help bring capital to the area. The reason I did that is because I spent the first 10 years of my career at Morgan Stanley Private Wealth Management in New York City, which is a small boutique group within the wealth management division that just caters specifically to clients with at least 20 million. So if I had to sort of summarize my 10 years that I've spent, I was either doing one of two things, to oversimplify. I was either asking someone very wealthy to give me their money, and then once I got it, people were telling me why I should give it to them to manage. So that's my world, is, you know, capital, fundraising, investment. I stay in my lane here. Everyone in this room probably knows like the other sort of 7 more important areas of starting a business better than I do. But this area I have to know pretty well. I came here late 2016 on my way to California. One of my best friends from college, a fellow Division III college football player, we're very proud of that, convinced me to stop here for 5 months and help him raise capital for his exciting local startup called Smarter Sorting, which is doing a great job. While I was here, I fell in love with the city. I saw a city that's being built right in front of us, which was, when you're coming from New York, was just really exciting. It's like a Series A town, I call it, if we want to speak in this kind of lingo. I actually just saw that I was a kind of a rare commodity here. Whereas in major cities, there's a lot of other people who spent 10 years on Wall Street. Here, not as much. This community had a lot of things that I don't have, tech skills, medical stuff, just, I can't raise my hands for those things, but everyone needs capital. And then I started reading about, you know, we could have greater connectivity with sort of coastal investors, and I sort of started checking some boxes, and the whole, hope I'm not doing that every time I say something stupid. Next slide. All right. So that's why I'm here. I didn't know what exactly it was going to be. So I just started giving people, you know, I thought a good way to sort of figure it out would be, you know, support the community for 4 or 5 months, which the cost of living here allows you to do. You couldn't do that for 4 or 5 days in New York. You'd go bankrupt, you know, and figure it out. So, and most recently, the sort of other larger hat that I'm wearing now is we are in a WeWork, which is a wonderful company. The former head of development at WeWork, Frank Bistrian, who opened, let's see, joined when there was 38 locations, opened the next 100, left to start Workwell Win, which is currently called, which is a new co-working operation, which is sort of more corporate co-working and with a wellness overlay. And we're opening 100,000 square feet in East Austin at the former Motorola campus. And we just sort of took over operations that was what was Journey Co-working, and now I'm managing that space, and we're excited to be able to say, like, you can start there and graduate to our 100,000 square foot. Anyway, that's who I am. Let's go. All right, next.
There's no clicker, they said, so.
Yeah, so I can't just do that. Yeah, all right. I'm a pro at this. All right, there's let's see, let's go through this. Some of the things I'm going to tell you are sort of like standard issue things about basically the toolkit that you got to put together. You should really see fundraising as a process. That is sort of a 3 to 6 month process that you sort of really come up with a game plan for. It's not sort of, oh, I'm going to raise some money, I'm going to work. It's like, I am going into a fundraising sort of world for the next 3 to 6 months, and I'm going to build a plan for that 6 months. The first thing, training camp, football analogies. Okay. The first thing is you need, if you're going to raise money, you need a business that can provide an attractive return on investment, which isn't every business. There are some businesses that aren't for, that are very good just on your own, maybe like opening a little store or something like that. You know how much it costs, how much the products cost, how much you can sell them for, and that's a nice business, but maybe not the best business for an investor. So that's the first thing you have to say, is does my business have the potential to return a very attractive return on investment? You know, in the venture capital world, that probably starts at a minimum, has a potential to you know, if they give you $1 million, they could get at least 10 million back. May not be, whether it's likely is a different story, but that potential needs to be built in. Angels, you have a little more flexibility, where someone can support you just because they like you or they believe in your cause. It's their money, they're free to do whatever they want with it. A venture capital firm has legal obligations to make sure they do amount of due diligence and it's a suitable investment, which means they can make a lot of money, you can make a lot of money, and their investors can make a lot of money, so it needs to be a big idea. All right, the first thing you do is determine how much to raise. It sounds very obvious, but you should really, it's an incredibly valuable exercise. I just went through it for opening a location. Exactly how much money do you need? Then I encourage you to raise it by 25% because you'll need more and it will take longer to get. But that process is, you should have a number. It can be 3 numbers. It can be, I need $1 million. We're targeting 1.25 million, and we can take up to 1.5 million, or we're raising 1 million. But you better have sort of, you know, when a young kid asks their parent for money, mom got $20, they say, what are you going to do with it? Like, you better be able to say why exactly that amount. And if you say, oh, like 700-ish, like, well, I'm not going to give money to someone who's raising 700-ish, you know? So let's see, the things you got to prepare. The first thing you have to do is excite someone about your business, 1 sentence, then 30 seconds. Here's my analogy for the fundraising process. And sometimes I even do this little talk, and then someone will send me a 47-page deck and ask me what I think. I go, I don't think, well, first of all, you probably listened to when I spoke. The fundraising a lot is like getting a scared little animal or wild animal to come closer and closer. You give a treat, they come closer, you give another treat. Wow, that's good, I'd like another. I'll give you another treat. Before they know it, they're standing close with you. Every engagement is about just getting the next engagement. So the second you sort of flood them, or they lose excitement, it's basically, I don't know, you want to do a fishing thing, reeling in a bit. The second you go too strong and they're off, they're off. You know, the second they get bored by your idea. You know, so the first thing you need to do is like, hey, I'm the founder and managing partner of J9 Partners. You know, we raise capital for Austin startups. Ooh, you raise capital? I need capital. Well, I know you do, that's why I said it, yeah. Then 30 seconds, then they might ask, oh, well, tell me a little bit more about that. Well, I spent 10 years at Morgan Stanley. Well, I already did that, so let's not do that. All right. But then I'd be like, all right, can I send you an overview, just a 1-pager? Hey, this looks great. Would you have an investment deck? Something? Will you send that over? Send that over. The investment deck, which is 10 to 15 pages, every time I come in to consult, it's a hacking exercise. It is about keeping them excited and getting to a meeting. That's what an investor deck is. There's 2 kinds, basically. One like this, that doesn't stand on its own, it's a presentation deck, right? And then you have an investor deck, which you should title investor deck with the month and year, which says, like, I'm sending this to you because we're raising capital and the information in here is up to date as of this date. And the purpose of that, like I said again, is to get a meeting. It is to give someone a very sort of high level understanding of your business, the problem that you're solving, your business plan, how much money you need, how you plan to spend it, what kind of market you're in, so they can check their boxes, okay? And then say, that's really exciting, come in and let's talk about it. When you come in and you talk about it, that's when you can sort of show your 2 years of or a lifetime of knowledge about your product, your business, or something like that. If the deck becomes that, it's over, okay? And then typically the step that comes after that is, all right, send us a pro forma, which should have already been done, but that's like, all right, we like it, we like you, we believe in you, because so much of this is about liking the founders. It's a bet on people just as much as the business has to check the boxes, but what's ultimately going to get investment is you as a founder. The financial models, I actually find this to be sort of the easiest way, especially in Austin, to differentiate yourself. I typically see presentations that say, okay, use of funds or raise or something like that, it's like $1 million, and then it's a pie chart, and it's like, some will be on marketing, and some will be on employees, and some will be on, well, that doesn't really mean anything to me. The way that slide should read, and again, I think doing it like this is probably the greatest way to differentiate yourself in this community. You're asking for someone's money, I think almost even out of respect, and this whole idea of respect I'm gonna get into on the second slide. It says like, this is exactly how I'm gonna spend your money. It's still on a page, it could just be sort of a, I'm going to spend, if it's 1 million, 150,000 on 3 new employees at 50,000 each. They will do this and then produce sort of this much value. I will be spending 200,000 on marketing, which will be online and some sort of other campaign. We believe that will result in this much value. So you say, you give me $1 million, I spend it. You give me $1 million, maybe at this valuation. After you give me that, I spend it like this over maybe the next 6 to 12 months. The result of that spend are all these good things that then add up to a much higher valuation than you gave it to me. So you actually show them, if you show them the path of their money. If the money comes to you and it's valued at this much, here's where it's going to go. What it's going to achieve when you add up those achievements, what was worth this is now worth this. At that point, we will be raising again. Giving clarity and getting granular about that will differentiate you, I promise, because I've probably seen 150 decks since I've been here. If you do a little more work there and use of funds, sort of the financial side, still make it 1 slide, maybe 2, it'll pop. Especially with the New York City crowd, which I'm always going to be guilty of tilting in that direction. I've talked to people who move from Silicon Valley, and it's not quite the same, but hey, I'm staying in my lane. Like I said, I know what I know.
Hey Johnny, when you do that 1-pager, do you need a chronology at all? Like, or
What?
you just say the 1-pager is like, in bulk I'm going to spend this, and at the end of the 18 months it will look like this, or is it, hey, I'm spending this first quarter, say.
I just get granular in like sort of, it could almost literally just be like a built-in spreadsheet to a PowerPoint slide. Like just get more specific.
Okay.
You can include then another column that says like sort of a result of it. Like sort of like if I spend 200,000 on marketing, it will get me this many more hits on my website or some other sort of very my background is all like show me numbers, just give me numbers, like just give me data. Wall Street isn't a very imaginative crowd, so I just want to track the flow of numbers and say like, well, if you're spending 200 there and you're getting that much, why wouldn't you be spending 300 or why? Just want to be able to have those conversations. So.
And is this going in the investor deck that you send ahead of time, or is this going in the presentation deck?
Well, the presentation deck and investor deck are just like 2 different things. One is just like I'm presenting, so I'm going to be able to talk. It's like just a lot less information, okay? Like this is a presentation deck. This would be, might stand on its own a little bit, but I made this with the idea that I'm going to be able to be up here and tell you what I'm talking about. I don't believe this could stand on its own. Be all right, but not that great, right? I would probably have more like a flow chart or something that made it really uneasy. Probably I should do that anyway. I'm gonna get a couple nods, yeah. Well, if you're a good designer, I'll hire you, because that's not my expertise.
Yeah, I guess my question was, when do you reveal that level?
The use of funds,
Yes.
it escalates along it could probably be first introduced well, first of all, you should know it before you start the process, like very specifically. When you introduce it for the first time, is in that 1-page executive summary, it might say just have 1 or 2, no, it wouldn't. Your 1-page summary would just say how much you're raising, in what form, and be an overview of the raise. You might have a bullet, but now that I'm saying it, I don't see any value in saying I'm going to spend 25% of it on marketing. I don't have any idea what that means or why that's better information than that person spending 15% of it on marketing or 40 like that. So any inclusion of excess information, like at each one of these levels, be like, does this make my story more compelling? Like, the way I just said it, like, if it said it in one page, 15% for marketing, like,
Who cares?
who cares, right, just get rid of it. So, but then, so the first time would be the investor deck. Like, which would come, you know, you say, hey, I got the new Uber for this. Really? Why'd you start that? 30 seconds. That's cool, send me a one-page executive summary. Hey, I really like this, can you send me over a full deck? Full deck followed by meeting, followed by maybe like some due diligence, but that's then pro forma, and you start getting into, that's sort of the flow.
Okay, thank you.
Is that cool? Does that answer?
No, that answered.
Yeah, I'm happy to show you one or two after, right?
Yeah.
And so build and polish, personal income. Oh yeah, what are you gonna do the first time you sort of, if you're an investor, right? Someone sends you a deck, I'll probably Google, you know, and see their website. I think your sort of website is the best investor deck there is. I even actually believe in, I don't see this very often, and again, this might be my own world, getting lost a little bit in Austin, but if on your website, you could maybe even have some link to investor material, maybe someone logs in, or just some way to protect it, or you have a sort of sublink. Like, what a great, easy way to show someone all the cool stuff about your company that wouldn't be in a deck, but also have the deck built in, but just make your website great. And by the way, my website isn't great, so you're like, God, that guy talked about website, you know, I'm not raising capital though, so, okay. And it's not what I'm good at, you know, yeah. If I was, I promise you it would be a lot better. Get some personal, oh yeah, just be ready, so like, hey, if someone's gonna be like, hey, can we talk to somebody you work for or done business with, just have all of those things ready to go. You know, all the tools that you might need, have them ready to go. Hey, so-and-so, former boss, former business partner, former someone, I'm about to raise capital, give them some intro, can I use you as a reference? Having that reference ready to go, I don't think you need to send someone like 4 references. Again, this falls into like sort of tools I might need and I wanna have ready. And then the execution plan, I didn't know if that was another get to it. Execution plan is like, all right, team, how are we gonna do this? Are we going to allocate this amount of time to this? I'm gonna be on the road for 4 months, so we need to do a call every morning. You can get lost in fundraising where you start saying like, oh, I need money, I should be spending time raising capital, but I also want my business to keep growing. So you just gotta get very organized on the plan. Like, listen, at the early stages, the CEO has to raise the money. They're like, it doesn't really work otherwise. So he's gonna be on there very focused on that. So he's gonna have to pass the operational and growth off. You just better go into fundraising like, all right, on June 1st, we are starting a 4-month fundraising plan. And one other tip I'll throw in there is, you know, what's typical to see is something like raising $1 million, convertible debt at 20% discount. What I always say is, listen, that first person who gives you the first $250,000 is taking a bigger risk and adding way more value than the person who's giving you the last $250,000. Why not give the first $250,000 a 30% discount, or the first $500,000 and the last $500,000 a 10% discount? First of all, it's appropriate because, as I said, you know, they're coming in earlier. They're taking a more risk than the person who's saying, oh, you already got 500 of the 1 million, I'll fill it. And it's easier to get the 500 being like, yeah, we've already got 500 in, we're just looking to, like, it just changed your whole narrative. So get that first 500 in. And then when it's all in, it still works out to 20%. Get your lead investor in. All right, I think there's just one more slide, yeah. Someone,
I've heard that there could be complexity if you're doing notes of changing terms. Or are you actually doing different notes?
no, you just build, you can build it right into a convertible debt offering, saying like the first 250,000, you will get these terms.
So it doesn't make it complex on the.
No, you just,
version or-
it's no different than, you know, my old days when a private equity firm saying that if they're raising $1 billion, if you give us $1 million, you get these terms. Or here, I used to manage clients' money, right? And if someone gave me $20 million, say it was, I charge them 1% of their assets. Someone who gave me $50 million, I may only charge 0.6% on their assets. That person's giving me a lot more, right? That's like just, you could also say like have a break point where like you get it if it comes in by a certain date, which I like doing. Like get that first load in, but set the whole thing up so that you, when it's full, you're still at that 20% term. Get the first money in though. It changes everything. Being out there saying I have 500 of 100 and we're looking to fill, man, is that a different world than being like we're raising $1 million, we're still looking for we're still jingling a can. So like it's just everyone likes what other people like. It's I know it's obvious, but it's never forget it really. And saying oh we're in talks with or like it's okay, but it's like it's good to present that there's a lot of interest, but to me and say oh we're like very close to closing these people, it goes in one ear and out the other. It's like it's almost better just not to say it. Be like, listen, we're very close, but there's nothing we can, we're getting a lot of interest. Just something that's like sort of, I almost give that person more credibility than the like, oh, we fully expect in 3 weeks to have closed. I'm like, why? Like, it's not your money, All right, let's go next one. I think that's it, by the way, someone can just like, hook me off at any time, I don't know. All right, these are like little outside the box things, and some of them I kind of covered, all right? Once you start fundraising, okay, like I see it as like, I keep going back to Morgan Stanley, that's all I got, sorry, that's where I spent my 10 years, I have no other, personal points to bring up. My division was the one who wore like the nicest clothes every day, like even out of all the other, snobby bankers and stuff, because we were asking really rich people to give us their money. And people feel comfortable, man, you don't have to go around wearing a tie or anything like that, giving like their money to someone who they see as very sort of buttoned up and organized. And granted, again, I come to you from my world that I come to you from. Mark Zuckerberg got a lot of money and did never put a tie on until he had to testify or whatever, so. All right, so these are my tips. They're not the right or wrong, they're just mine. But just be respectful, just remember, like it's not, there is no entitlement to that money. And it's not just, hey, why won't these people give me money? I have this great idea, because it's not about just that. It's not just about whether you have a good opportunity for them. Is it the best opportunity for them? They're gonna see 100 other things. So just because yours is good, doesn't mean that other ones aren't better, or in industries that they understand more. And that just reminds me of one other thing. A good way to show respect is to do research on the people. So if you actually now say like, all right, I don't need this money for 3 months or so, you can do, say like for 2 weeks, I'm going to, because especially angel investing tends to be local, right? It's very unlikely that, unless there's someone or there's some, connection, that your first round of capital, after friends and family, will be from a Seattle angel or so, unless, they happen to really know that space and something. So you spend 2 weeks, be like, all right, here's all the angel investors in Austin. And those lists aren't hard to find. I have a couple of them. All right, let me now see like who's invested in my kind of company, where they hang out, what they do, and I'm going to work backwards from them. You say, hello, XYZ. First of all, you want to do this in person, always first, right? You get your face in front of their face, there's nothing better. And you say, like I would say my little J9 partner spiel in front of someone who I know was looking to raise capital. Be like, wait, I'm looking to raise capital. Be like, oh really? Well, I kind of knew that. But when you say like you're talking to an angel investor, like, and they invest in social media type companies in early rounds, Austin based, you would say like, I have it's not even a proper category, but an app, and I'm raising $1 million, and I'm Austin based, and it just happens to be, oh wait, didn't you just invest in 3 other companies that check those boxes? And then you could even joke and be like, I know you did, that's why I made sure I got my face. Just something that shows you've worked backwards from them, right? Because that is 15 encounters like that is so much better than hitting every single like angel investor in Texas with some blanket email that just says, hi, I'm raising capital, like that email just gets deleted. Okay, at some point you have to make a decision where you can't do that for everyone. Always face to face first. If not, then if they're really a good fit and they're local, send them an email that just says like, I have done my homework about you, I know this is a good fit, here's a little info with a one-pager. You know, that just shows me, hey, at least these people are professional and, you know, they've really taken time to understand the kind of investments I look for. A couple other things I said, like stick to your schedule, like again, fundraising, as I know from, I was I can't use the word here, but let's just say I was overly available before I really had any clients, and I was, you know, being told if I didn't bring in 20 million, you know, we were all gone. I was just very accommodating. If someone said like, I could just meet at 3, I can meet at 4, I can meet at 5. Now granted, you should be very flexible, but it is very helpful to be like, I have availability. This time I can like move stuff around, but like you have a schedule, even fundraising. Like I like hearing that people say, listen, it gets crazy, but going into this process, I knew like I had to stay like happy and healthy and still like live you know, stick to a schedule. So every morning I get up at this time, I go exercise, I go for a walk, I read the paper, and then I get to our office at this time and I spend fundraising. Like I would like to hear that more than someone who says, man, I'm up till 2 every morning. Like, I don't think that person's going to be in it. So just everything you show is like sort of just show your sort of, you know, buttoned upness, show your professionalness, and a couple other things, like just be confident, don't be cocky. You know, can't say I've never been accused of that. So, but confident, just like I have a great business plan, I've carefully thought it out. I'm raising this amount of money to do this, you know, and our expectation is that this will happen. You're someone we've identified as a great strategic investor. If it's not for you, I understand, and I will move on. Like, very confident, like the more prep you do, the preparation is key to success, all that, it's really true. The more you know your financials, the more you know everything, the more like sort of lean forward you'll be in that meeting, the higher you'll be sitting in that meeting, right? So be confident, but you can't just say be confident, it really comes with your preparation, right? Never lie, I kind of touched on that being like, oh yeah, we got you know, Sequoia invested, but it's not really Sequoia, it's like kind of some, I just had this happen, it's kind of like some, it wasn't like Sequoia invested, you know? And when I found out it wasn't really like that, like I was like, like listen, you should always put your best foot forward, but there's a line, right? The second, it's better to err on the like sort of I'm still being very truthful side of that line than overstep that line. Because again, it's like the analogy I gave you, too much information. Well, certainly any information that is false or like leads them to down a path that is you kind of expect to, you know, they'll sort of assume false information. That's a game over situation, you know? I was telling someone the other day, I was like, well, do you have any clients yet? And they're like, who was someone saying they should build a website for this company? And I said, well, who have you done one for? And they just gave me like these long answers, like about like, I go, listen, you're a startup, it's okay if you don't have any, just be like, we don't have any, but look at ours, it's great. You know, just whatever. So always write a thank you email, and again, these are just sort of outside of that, like just, that's very, and don't include an ask when you write the thank you email, because you could thank someone and then be like, when would be, just thank someone for taking the time. The people you are meeting with get approached a lot. They have businesses, they get like just, and mean it. Thank them for taking the time. And you could say something like, and I'll follow up like in a couple of days again, but right now all I wanted to do was thank you because I greatly appreciate you taking the time. I know how busy you are. Never stop practicing your pitch, but don't obsess about the marketing materials. I could get so, like, be found so guilty of this. Like, you know, should this go here or should this go here, right? It's like gets de minimis at some point, right? It's like you have to, I think it is called like the 80% solution or something in business, people say, right? Like where,
80/20 rule.
what?
80/20
The 80/20 rule, yeah, I mean, I just give my things with my own titles, yeah. Yeah, and for anyone who doesn't know that, it's basically like, get things to 80% satisfaction, because what starts happening after that is the amount of time it takes to go from 80 to 84 just isn't worth that amount of time, but it is worth getting it to 80. But if you spend 4 hours like playing with color patterns and stuff instead of like being where at some function where there's a lot of angels, or sending out 3 really clean, like targeted emails to it. Like once you get your materials, practice your pitch, revisit them, send them to people for their feedback, but you're done. Update them, don't change them, man. And I said this at the beginning, add significant developments monthly. Every deck should just be like, listen, this is about raising capital, and as of May 2018, it's up to date. I have no idea what time it is, that's all I got. I hope I didn't go too long. I'm free for as much as you need.
10 more minutes to.
10 more minutes to rant? What about questions and stuff?
Let's do that.
Yeah, well, let's do that. All right, my man. Yeah.
So, should you make first contacts to an investor by email, like just a cold email? Should you even do it?
Do the rankings. Always best. You have to make a determination. You have 4 months to raise the money, which means, let's call it 6 months. Okay? So if I'm about to go raise $1 million starting June 1, I need it by December 1st. Okay? You say like, all right, these 25, these are my most targeted investors. I'm going to give myself 1 month or 3 weeks to meet them in person. After that, I better start reaching out to them by email. But even better than that, if you know somebody who knows them, who says, yo, this guy's, so I would rank that second to the cold email, It's probably right up there with your own face-to-face, just depending on like what kind of endorsement it would be. Like if someone, who people are gonna be like, whoa, this person's telling me that I should strongly consider this, versus, your mom being like, trust me, my son or daughter's got a great plan. Like, you gotta weigh those things. You also gotta weigh like how effective you find you are face-to-face. If you are a really like sort of shy, you should practice it, but maybe it's not very important for your business that you are like, sort of client-facing. So, if it's more like you're kind of a developer building something, get someone to be like, listen, I've worked with this person. They're great, so again, go for those things, but you have sort of, it's probably gonna take someone at least like 2 months from the time you first, and in my old business, they said, from the time you met someone to the time you became their wealth manager was 18 months. I mean, that is insane. I'm like, well, why do we have 12 months to raise this money then? So, but that's another issue for another time. Yeah, you just gotta, say if I can't meet them in person, then I'm gonna send them an email or get someone to introduce me, but.
And that first email, if you decide to go that route, should it have your complete deck?
No. No. That's what I started by saying. The second someone I've never heard of sends me a deck, like it's too much. Like it's just like, hey, I've got a company that does this. I see that you invest in companies. Here's a 1-pager, just really high level. Like, could I tell you more? Like, I know you, once you finish a deck, and I've done this, you like want to show it to people. And you're like, I've got this great deck, man, I've got this great company, I know everything about my company. But, no, I know it's frustrating. This is why these are like, the crumbs thing. It's just like, come on, come here, not like, oh my God, you're the cutest thing I've ever seen, like it's a little bit, yeah.
How do you, and I don't even know how to phrase this, but how
investor and they tell you to tweak your pitch, you know, give you advice on your pitch, and it's this every single person you meet has their opinion of what your deck should look like, what your pitch should, you need to do this, had you done this, you know.
Yeah,
It's
okay.
just this constant, when do you turn that off?
All right, well, a couple points on that. The person who is giving you that feedback is probably not going to invest. Like, right, so if someone sends me it and they're like, they want money, and I know, like, if I say tweak your deck, be like, hey, thanks, but I just really wanted to know if you're gonna invest or not. Like, you know, like, so what I'd say is you listen, you have to, if someone does say something and that person has raised capital 15 times and says, like, if you do these tweaks, I actually did just say this to someone, if you kind of rebrand, but that's a little bigger thing than a tweak. I'll send this to my audience, but I think your name is really bad now. And like, if I send something to someone, that means I endorse it. And you don't want me to send it being like, I think this company's good, but it has a bad, you know. So I would say, like, again, like if you're gonna give, say, 5 months for investment, be like, we're gonna do 6 weeks of pulling these marketing materials together. After the first 2 to 3 weeks, we're gonna have what we find is our 80%. We're gonna leave 2 weeks to get it out to our people for feedback. We're gonna get that feedback, decide what we like, what we think's good, and then we're locked in. At that point, maybe once a month, again, unless it's a unique thing, you'll revisit your deck, be like, all right, what do we have to add this month? Like a significant, we got a big new customer, our website traffic is up 300%. We just secured 300,000 of our 1 million. That's the time to say, okay, what we're also going to do is these tweaks. Like I would say each month, be like, when you change the date, be like, all right, this is what we got. Yeah, I'm so sympathetic to that because like, I know I get that. I'm like, wait, good. And then I'm like, where did the last 4 hours go of me being like, well, now I moved this here and like, so. What else we got here?
Could you talk more about the discounts that you mentioned?
Mhm.
So if you're giving 30% discount to your first investors of $1 million total, and then you're meeting people later, is it, how do you navigate the whole thing where you didn't even ask them early on? So they're kind of, or do they feel like they're getting?
Well, here's the thing, no, the people in my world, if I saw an investment where now you had $500,000 in, and so there was only a 10% discount available to me, I'm telling you, my first thought would be, oh, that was smart. That they did that. I would actually probably give up that 10% and say that, like, I'm happy, I'm still more inclined because I think that was a good move. And I'm more inclined to invest in something where they have 500,000 of $1 million. Those people at the beginning should, it was actually funny coming here, I knew about sort of at least prudent every type of investment asset class except sort of startup financing. If one of my clients wanted to invest in a private, their like nephew's company, or be like, whatever, I'm just gonna assume you lose it. And that's kind of all I knew. I wasn't allowed to, offer products that weren't sort of supported by Morgan Stanley research. And someone's nephew's startup, obviously I couldn't sort of speak, from Morgan Stanley as that. Just be like, all right, take 10% of your money, and we're just gonna assume you lose it. But I promise you my first thought would be, wow, that was smart, and 2, if I was seeing this and they hadn't done that, it would probably be an opportunity to be the first investor at a 20% discount, and I just think, like I would rather than have the 500,000. And you could still, as an investor, might make you an offer. Say like, I'll, fill it if I get the same terms, and you then decide if that investor here's one thing I would say, so like I put my old clients or investors into 3 buckets, alright? And, the first bucket is someone who gives you $1, and the value of that dollar is actually 50 cents because they're just a huge pain in the ass. Right? They're complaining, they like are like just, that's bucket 1. So that dollar is actually 50 cents that they give you. Bucket 2 is they gave you $1, and it's $1. It's like, here's a dollar, and then they are gone, and $1 is $1. The third bucket is the person who gives you $1 and it's actually worth $2. And we call it strategic investors, and I love that world where, like, you know, they're an investor who then is also going to get you customers, or going to lead your next round, or find you the rest of your investors. So if you come to sort of a crossroad that you just mentioned, you determine if that person, right, is what bucket they fall into. If they are that third bucket, you may want to say, you know what, you know, for you we'll do 20%, like you see it on Shark Tank all the time, right? Like, you basically would go, if I was going on that show, I would say for my product, like, each one of these sharks, and sort of assign a value to each of them. So if they made me offers, or they were competing with each other, I would know which, like, say, like, so Mark Cuban's $1 million is worth more than, so I need to know that going into it, because if I try to start, you know, but I actually think that person would say, like, no, listen, we're very comfortable, we're gonna stick to this schedule. I think the person would actually be more inclined, if you projected that fortitude and confidence, to be like, no, we're very comfortable with our, you know, setup here. We've, you know, already locked in 500, we have a lot of interest, like, and we'd love to have you, but these are the terms. You gotta feel that a little bit, but my guess is, people like what they can't have, but like, you can't, you know, it's just weird when you say, like, listen, we're not raising capital right now, we'll let you, be like, wait, you're not, like, but, so dumb, but it's true, you know? So how do you do that again, to that line, where you're just very professional, and it's very hard, I've been there where you're like, man, please give me your money, please give me your money, please give me your money, but, again, if you know, like, you're organized, and be like, I have another month, like, when it's like, shoot, and then you say, like, all right, well, this money is gonna last 9 months, so for 4 months after we get it, 5 months, we're not even gonna think about fundraising, maybe we'll, you know, have a meeting here or there to set the table. But if you're just constantly swimming in this fundraising world where you need capital, you're not gonna get it, it's gonna take all your time, you're gonna be like, whatever terms you want, man, just give me money. And then they won't give it to you because you're like that. I mean, they might, but.
On that note, how long should you ideally keep your round open?
How long should you keep it open? I mean, I don't know, at some point it's like a house that's been on the market too long, right, where it loses value. You're almost better to just like hit a reset button, you know, like something's wrong, like if you haven't, like you either, your product isn't right, you didn't run a proper process, like, be like, because that's actually a really good point. Like if I talk to someone who's been like, all right, we've been looking for capital for a year now, I'd be like, stop looking for capital, take a month and like relaunch or something, and you know, or even just say like you're not looking for capital, because when you say like I've been looking for a year and no one's given it to you, like, you know, that's what but I like, it's typically like a 5-month like process that you would allow for, and I would say like take that first 2.5 months and say like incentivize, get that first slug in, but the rest of it is so, and be like, that's why I would even include like 30% discount, or if you invest up to this much prior to, like if it was right now, September 1st, you get these terms, and you know what, if everyone gets 30% off and you fill your $1 million before September 1st, that's absolutely worth it. Because you just, I mean, you gave up a little bit of equity, but you just got back 3 months of time to build your business. Like I mean, I'm sure almost everyone would be happy with a scenario. Like, just, you want money in? Like, set up mechanisms to incentivize people to give it to you now. If it's the same terms, for me to give the last 100,000 as the first, why would I give the first? And by the way, this is not something I see a lot, that's me being like, I don't get it. And then I found out you could do it, and I think you should do it.
Is that would only be for, I'm assuming you can't do that for a price round, that's just for convertible notes?
Yeah, I mean, a lot of this stuff where I'm talking about today is like sort of focusing on, like, earlier, I mean, once you are getting to price rounds, a lot of these are different conversations just across the board, right? You have people who have invested, who can make like, it's just, your business is at a different, you've gone through previous rounds, probably. No, but even, listen, if you have a price round, you're doing a Series B round, and you know, it's Mark Cuban or someone like that, you'd be like, hey, I'll give you a board seat, I wouldn't give this person a board seat, I'll give you, I mean, again, the Shark Tank thing, you know, it's like, well, I'll give these guys these terms, but that doesn't, these guys are more valuable than some of the other people, right? Again, this dollar's worth $2, so, you know.
So if you, let's say you were raising a sum, and I came in a little bit late, so sorry.
So did I.
Tell me if you.
Yeah.
So if you are trying to raise 750 and you've raised 500 of it and you just can't get that last 250, what happens, or what do you do?
Well, here's something, so you gotta set these things up, right? Because me as an investor, what I don't want to happen, right? So there's provisions, right? Because I don't wanna give someone the first $150,000 and have them pay their employees for 3 months and then run out, right? I mean, so, what you would say is something like, you'd have a provision where they can't spend it until they hit a certain amount. You'd say, like, I said at the beginning, like, you normally have either one number, we're raising $1 million. I actually think some kind of, by the way, there's an opportunity to not just raise $1 million, because it's like, we're raising $1 million because it's $1 million, it's a whole number, and that's what we read you do at the beginning. Like, I think even being like we were raising 1.2 or 850,000, just differ. I mean, this is kind of dumb, but like, when I see like, oh, you're raising $1 million, the answer has to be because $1 million's like a very round number, and we know people typically raise $1 million. So you want it to be a little more well thought out, just make it a little different, unless you think that's going to be obvious in that way too. Like, anyway, I digress. You would just have a provision probably in there saying, you know, we need 400,000 in the bank before we can start spending this capital, because at least at 400,000, we can sort of do things that would produce a return on that. Where it's like, if someone gives you 100 grand and you just continue to pay yourself and your employees to go fundraise for the next 3 months, it depends on the business, but all that stuff built in. These contracts are a lot like, you know, you might make a deal with a friend, like you can borrow money if you do this for me, or you can't. You like it's.
Yeah, I was kind of thinking about what's typical, what are people used to saying, and what are they okay with?
I would come up with more like specific language, like let's set the table in these. I work with a great, you know, local venture. I'll plug Brad Wood. He's my guy here that helps me with this stuff, and I'm like, I think we should structure it like this. Can we? So it sort of starts with me saying, like, take out like legal can we. I think we should incentivize people like this.
Right.
Can we? And normally the answer is yeah, sure, as long as it's like just like most things. As long as it's just sort of above the board presented to someone, like, would you like to invest in my company? These are the terms. It's that person's decision to agree or disagree. They could say, yes, but, you know, it's like leasing an apartment. Like, oh, here's the price. Well, I can only pay this much. Can we negotiate? No. Okay, well, I'll either pay it or I really don't have that money. Start with doing it, then check with your lawyer, right? But I think being thoughtful about the raise, again, is like thoughtful about the use of funds. It always is like the afterthought in Austin is like that, the whole financial, like, and again, I'm probably too skewed in that world, but I actually think that's why me being here is just a healthy mix of like my old world coming with, you know, if you mix me up with all you guys, probably something that like is pretty productive, which I found, you know. No need for the cufflinks every day and stuff like that ever, yeah. but, yeah.
Do you have time for another, question
Yeah.
about, cap, like, what do you set it at that's, I've heard it's a de facto valuation for your company. You go too low, too high.
Well, here's the thing, the valuation cap is not really a valuation, it's just saying like, listen, the company doesn't have, value yet, it will, but no matter what it is when we price this round, your valuation will be this, right? So if like, someone lends you money with a valuation cap of 10 million, right? When it converts later, because if you don't have the cap, right, you invest, and the value of the company is either really big or really small, it's like there's a lot of stuff that can change between when you give your like, it helps like sort of tighten it up, saying like, eventually my money will convert at this, just kicking it down the road, but putting a ceiling or a floor underneath it, that's all it is.
How do you go about finding an appropriate number though, for that?
The number,
Yeah.
you would, there's like one book, my buddy told me to read it and reread it, it's just, read the book called Venture Deals, like it's, it's just, it's like one of the 2 books in the office that I have now, cause I just pull it out, like if I've been out of this world for a couple weeks or whatever, like I, fall asleep reading it, it's like the best way to educate yourself on this side of it, which is actually very confusing, some of the math even that goes on here, but, using stuff like PitchBook and Angel List and Crunchbase and stuff, you could see the norms, like what an average, like Austin startup at, a seed round of this much, there's like, I'll just tell you that like probably the average Austin seed round, like first round after, your friend is like say $500,000 and I bet you the cap is like, 5.5, 6 million. And you need to be aware of that because if you're saying your cap is 10, you better be able to say why, you're at the same stage that other Austin startups are at, but you have a higher cap. You better be able to say like, listen, this is norm, or mine's higher because I'm better, like, here's why. So it's always, important to know sort of the baseline. Even in terms of like, how much do I pay people, there's like when you do the use of funds, you should be aware that like, say after you raise that first round, it's like reasonable to pay yourself maybe, $40,000 to $60,000 or something at some point. And so when if you put 80,000 in your financial model that you share, like that's going to be an immediate red flag, and you may not even know why, right? I'm coming from New York, 80,000 in New York is, it's twice as much, if not more here, right? So what that message will send is, one, you haven't done your homework in terms of what people in Austin get paid at this stage. 3 is, you're willing to give up equity in your company to take like a higher salary now, which is basically the last thing you want to see from a founder, right? You want to say like, listen, I need this much to live and not stress about paying a mortgage and home, and I have kids, but after that, I don't want to give up any of my company that I don't have to. I don't want to see someone like who's saying, I'll pay myself $28,000. I was like, I don't want you to only make $28,000, because you know what you're going to do if you do that? You're probably going to be doing other jobs. And I don't want to invest in somebody who's also bartending and consulting. Just say like, listen, I need 50,000. That's the norm. That's what I need to focus on the business properly. But not it's not 55.
I'm getting some conflicting advice from different advisors in terms of, should I raise the full amount that I need anticipated to get to break even, or should I break it into milestones? Which your take on?
What? Give me an example. Like typically.
So I have a regulated product, and let's say it'll be, I'll make the number 3 million to get to market, and they're saying we'll go with 1.2 and get to this regulatory milestone first.
Oh yeah,
And some
absolutely.
guys are saying raise the full amount because
Yeah,
They
well,
need 18 to 24 months of runway.
that's, listen, I don't know business well enough.
Yeah.
A couple points on that. One is, you actually wouldn't want to raise the whole 3 million now, because your company, you'd be giving up a lot of equity at like your current value of,
Nascent stage, okay.
yeah, like, so I mean, like, I wouldn't want, you know, to do that. I wouldn't wanna invest in somebody who wanted to do that. What you do is say, like, I'm gonna need 3 million over the next 24 months, so I'm gonna raise 800,000, followed like 500,000, followed by 2.5 million, because the 500, for a lot of reasons. One is 500,000 gives me 9 months of runway. It allows me 4 months to be head down, focus on that, and then sort of properly start the next raise. Whereas like if you do 3 million, you'll probably just be fundraising straight through. And two is like, so if I raise 500,000 with let's just leave caps and price round off the table, and my company is valued at $5 million. Then I can raise 2.5 million, and my company is worth 25 million, right? So now I've raised 3 million, 30 million, which is, whereas if you raise 3 million, now you're raising 3 million at $5 million. That's just, it's actually not feasible that you could ever raise capital again, because you've given away all the equity in the company, and you certainly won't be that motivated. It's not practical, actually.
Okay, thank you.
You could, if for some reason you're saying like, listen, my company's worth 100 million now,
Right.
and I can defend that.
It would have put my cap rate above what's traditional in Austin to raise.
Yeah, you
It
just-
could have done in Silicon Valley, but not here.
Oh, that's why I think every deck in Austin should be telling people that, like, listen, my company is pretty geographically agnostic, right? You get to get my company at a 50%, this is, a Wall Street argument again. You get to invest in my company at a 50% discount, as if I was just sitting in San Francisco doing the exact same stuff. 50% of your money would go to my rent, my employees' rent, our meals, rather than the growth. So like, if you're gonna, sprinkle some investments around, like you can, make 2 investments for the price of 1. Like those are all arguments that would resonate with me
I
too.
understand your deck, so we're raising a fairly large round, and we've been pitching to various places in the Bay. The general comment was like, oh, you're raising too little, when really, our engineer cost is half the price of the Bay. So how do you actually properly word that, so that kind of?
Well, if you're saying you're raising too little, you might be raising too little for the entities that you're,
That's not.
no, that's not it. So they're just saying, it's probably business specific, being like, listen, if you're going to, getting back to milestones, right? Like if this raise is about getting to a sort of a milestone with your business, that's probably just feedback saying like, we don't think this amount of money.
Oh.
No.
The spreadsheet with our engineer headcounts and whatnot over the course of the 2-year period, and so the numbers are backed up based on.
Well, what they're saying, they're saying you're not raising enough. What's the next sentence? Like, you're not raising enough.
We've
Why?
honestly got some really crazy feedback from people in the Bay, like one guy even told us not to have a number on our ass slide, which is really.
I mean, the only time I've spent, like, most time I've spent in the Bay is like, when I was right out of college going to Beta Breakers, and like, I would count that as like me being very prudent on like, Bay life. But I don't know, I just think like, my New York mind tells me like, just go to the numbers, and they would be able to go through your pro forma and be like, we think this number is way too low. Like, you're gonna need to hire more people, or you're going to need, like, if they're telling you your number is too low, they better be able to say like, where it's too low.
Yeah, I think our numbers adjusted over time, so I think right now it's kind of at the point we actually need it. Some want we're a hardware company, so one far more software side than we actually have in our company, things like that. But compared to the Bay Area startups, we are very cheap, and that somehow seems strange to people at times.
I mean, I'm sure a lot of things I say seem strange to people in Australia. I don't know. I don't know, other than I would just be surprised if they couldn't, quantify it a little bit more than that, especially hardware. It would just be like, if there's no way you're gonna be able to build all this stuff unless you raise more, or so, I don't know.
It's probably more for later offline.
Yeah, anyway, I think that's it for me. I'm gonna, put everyone to sleep if I go on anymore, but I got my cards up here. I'll stick around for a few minutes, and, yeah, that's all I got. I don't know, like, do I say bye or something? I think my back's really sweaty, so I'm gonna like walk like this, but I can't, cause I went to the wrong building. What's up, man? How you doing? Good to see you again. Yeah. I left cards up there, by the way. Yeah, so, yeah, no, I know.